Hi everyone, thank you so much for joining us today in here online. So thank you so much for joining us in YouTube land. If you're watching us live or watching us a little bit later, thank you so much for choosing to spend your time with us today. My name is Sokha Yous. I'm a financial wellness counselor here with Mayo Employees Federal Credit Union. Today's topic, we're going to talk about getting yourself out of debt. That's usually on a lot of people's to-do list or New Year's resolution, starting the new year out. So if you find yourself in this situation, just know you're not alone. So if you do need help, you're more than welcome to reach out to me or other financial wellness counselor here with Mayo Employee Federal Credit Union as well. So today, at any time you have any questions here in person or online, please just ask the questions and then Christian will be able to go ahead and relay it to me from YouTube, or if you're here in person, or if you're a little shy, or if you're watching this later, you're more than welcome to reach out to me. This is my phone number, my email address, so please reach out to me. My information, you can find this information on financial education and on our website as well. So on today's agenda, my contact information will be at the end of the presentation as well if you can't write this down now. So on today's agenda, we're going to talk about what is debt. We're going to talk about good debt versus debt, the importance of getting out of debt, so how debt affects your credit score, your borrowing ability, how it affects your life in general, right? So the importance of budgeting and having emergency savings while you're in the process of debt repayment as well. How does that work? Which one is more important, right? So which one should we focus on first, or do we do it, alongside with paying off debt as well? Different types of debt in the average U.S. household. So that means, if you think your credit card balance is too high, just know maybe you're falling to the average category with the U.S. Household debt. Different options to pay off debt, and then we have, then I'll go ahead and do a little presentation with debt snowball and debt avalanche demonstration. With an Excel spreadsheet that'll be available for everyone to download. So it's a free, free template and stuff for you guys to use. So first things first, what is debt? What is good debt versus bad debt? For a lot of people, mortgages, a lot of people have mortgages, so for some people it's bad debt, but for a lot of people it's good debt because if you're getting equity from it, it's giving you, it's helping you make money and helping secure your future also, so that's considered good debt. Education, some people consider the education debt, the student loan debt, good debt, or some people consider it bad debt, depending if they're, they're paying back ability and if they're using their degrees and stuff to help them move forward in life. Vehicle loans, for the most part, we all need vehicles to get around here in Minnesota at least, but if you are lucky enough to live in an area where you can use the bus or other train, other source of transportation, then that's wonderful. But for some people, they consider a vehicle loan a bad debt because it's just something that's really weighing them down, right? And the average vehicle loans now in 2025, I don't have the 2026 figure yet, but 2025 is like $680 for a vehicle loan. So if you find yourself with one of these vehicle loan payments, you're not alone at all. So that's another thing that's really keeping a lot of people back from reaching their financial goals and stuff because of their vehicle loans. And on top of that, you're not just paying the vehicle loan, you're paying the insurance on top of that. It's when you're getting a new loan, does your insurance go up? Does it go down? Your tabs that you have to pay each year, does it go up? How expensive it is. And credit card debt, for the most part, if you're using it to help your credit card debt, just keep it under wraps and keep it under control, is for the most part good debt. But if you find yourself, and as one of the millions of people in the U.S. that are struggling with credit card debt, then you're not alone. Then that's considered, of course, bad debt, right? Because the interest rates are tending to be a little bit higher, harder to get out of, so that's considered bad debt. Investment debt depends what your investment in. If you're making money, if you borrowed money to invest into something and just making you money, then that's considered good debt. Certain business debts are considered bad debt too, of course, if the business is failing or not moving forward. Payday lenders are always bad debt. So the interest rates are really, really high. It's actually illegal in some states. So it's really important that if you find yourself reaching out to a payday lender, reach out to your credit union first or your financial institution to see if there's other options for you to explore before actually getting a payday loan, because it's really again, the interest rate is enormous, and it's really hard for people to get out of. So then the average U.S. household, 56% of Americans say their household is struggling with debt, so you're not alone. 1 in 3 people feel like their credit card companies own them because they owe a lot of credit card debt with high interest rates. So you feel like every month you're working, you may be working for mail, you may be working for the credit union, but if you constantly have to pay your credit cards back, it feels like, you actually you work for American Express and you owe American Express all this money. So it feels like you're not in control of your own finances when you have so much debt. 30% of Americans think their household debt is affecting their health, and that's true. I see a lot of people in my office that are having anxiety attacks, or they have anxiety and they have depression about their current debt, about the upcoming debt, the next payday. How am I going to keep up with my car payment if I can't even afford to buy food? So I think the number should be higher than 38%, but this is part, from the survey. And 2 in 5 say debt is a source of conflict in their household. I think debt is number 2 when it comes to, it's the second reason behind infidelity, why people, get divorces in the U.S. So it's really, really important that you and your partner are very open and very transparent about your debt, about your financial journey, about your relationship with finances, if you're aware of what your relationship is. And 46% of American households struggle most with credit card debt. That's a lot. That's a lot of people that, really needs help with paying off their credit cards, trying to organize and see which bills to pay first, see which debt to pay off first. And number 2 is your mortgage. As we know, mortgages are going up and house prices constantly go up. But if you're renting, rent is constantly goes up every year too. And of course, student loans, 13% of U.S. households struggles paying their student loans back, especially with student loans kicking back up and everything. So again, if you find yourself in this situation, you're not alone, but that doesn't make you feel any better, right? So the goal is, how do I get myself out of this situation? Again, just another look at it. Average U.S. household debt, 70% of mortgage, 70% of, most of the debt are from mortgage debt, student loans, auto loans, home equity line of credit, and other personal debt as well, and credit card debt. So if you find yourself in this situation. The importance of getting out of debt, it improves your financial freedom tremendously. So eliminating debt gives you more disposable income to save, to invest in your future, and to build wealth. So if you are, if you barely have enough to cover your credit card bills, but you know that you have to start a 529 plan, like a college savings fund for your kids, but you have to pay your credit card bills, each month. And the longer you have debt that you have to pay on, the less amount of time you have to invest in your future, your kids' future, and work towards your financial goals. So reduce financial stress. Once you pay off your debt, of course, it reduces your financial stress by a lot. 50% of borrowers worry about their debt. And increase your stability too. So without monthly debt payments, emergencies are less likely to throw you off your entire budget. I think it's about 46% of U.S. households can't come up with $400, 36% of U.S. households can't come up with $400 in emergency to pay towards an emergency, and that's $400 cash without using your credit card. So that's a lot of households. So if you have an emergency and you have the stability of not paying debt off, of not having debt, then a lot of times if emergency does come up, you're not so stressed about it. You have money in your emergency savings, you have money in a different savings account, so you're not too stressed about emergencies and stuff if that comes up. And it creates other opportunities too. It helps you build better credit, opens doors for home ownership, business loans, or lower your interest rates and other loans as well because of your debt to income ratio. We can't talk about debt without talking about your credit score, right? So what goes into your credit score? 35% of your credit score makes up of your payment history, and 30% of your credit score is rated on amounts you owed. So it's important for you to stay under 30% of your utilization. So for example, if you have a $10,000 credit card, available credit, we don't want you to go over 30%, so $3,000, right? So because anything over 30% puts you in a higher risk of not being able to pay it back. So it's really important that you utilize your credit card strategically. So don't max out your credit cards. That really lowers your credit score. And 10% of your credit score comes from a new credit. So you want to limit new credit as much as possible, because once you open up more new credit, it really shortens the lifetime of your credit history, and that makes up to 15% of your credit score. And of course, 10% is credit mix. So things like, do you have a car loan? Do you have student loans, mortgage, personal loans, and credit cards on your credit report? It shows that you have the ability to really take care of and handle different types of loan. But if you don't have all those things on your credit report, that doesn't mean you should go out and get those new loans. Just handle the ones that you already have on your credit report now. So the role they play in our financial lives, the ability to obtain a loan, so getting a mortgage, getting a car loan, student loans, not federal student loans, but personal student loans. It really affects your interest rates. So the lower your credit score, the higher the interest rate. The higher the interest rate, the more monthly payments you have to pay. The more monthly payments means that less money in your pocket at the end of the month to reach your financial goals. It can also affect your ability to rent places too. If your credit score is too low, you might be a risk tenant, so they might not take you on. Believe it or not, with car insurance rate, it affects your premiums too. So after your driving history, the second most important thing they look at is your credit score, your credit history. Just to rate to see how you are as kind of a whole as a person too, when it comes to your premiums. So it really affects it. So you find yourself paying a really high car insurance, and you've really been working on improving your credit score, you might want to go ahead and start reaching out to different insurance companies, shop around a little bit and see if they can give you a lower rate since your credit score has gone up. But also on the opposite, if your credit score has gone down, let's not shop around for car insurance just yet. Wait until your credit score goes up a little bit. And there are certain places that really use your credit score as part of their employment too, to see if you're employable, to see if it's safe for them to hire you as an employee to work for them. Your credit profile is very specific to you, so it's important to know your credit score and how it's calculated. We just went over that. Make thoughtful and deliberate choices, so that's really important. Review your credit report at least once a year, so you can always go. A lot of people have Credit Karma. A lot of people have, their credit score based on from their credit cards or from their bank, but a free way to do it, another free way and a safe way to do it, is go to annualcreditreport.com. Just to make sure that you pull up all three credit bureaus, right? So pull up Experian, Equifax, and TransUnion. Compare what's on there. Is your address correct? Is your phone number or all the debt reported correctly? Just to make sure that everything on there is reported correctly across all three major credit bureaus. How paying off debt will improve your ability to borrow. It increases your credit score by lowering the credit utilization, and it lowers your debt to income ratio too. It provides you with more available credit for you to reach your other financial goals. So it's the higher credit score, the more competitive your loan offers are going to be. So it's really important that you make sure that when you're applying for a loan, just make sure that your credit is the highest that it can possibly be at that moment. Borrowing ability, debt to income borrowing example. So for example, in this situation, Sarah's gross income is $6,000. Her total debt is $1,000. So that shows that her debt to income ratio is 16%. So it's really important that you stay under 40%. So this is just an example, a very basic, small example of what debt to income ratio is. So we want you to stay under, 40 or 42%. So the lower, the better. Okay, so what is a budget? So we can't talk about paying off debt without talking about a budget. So a budget is simply put, it's a spending plan based on your income and your expenses and your financial goals. It's really important to keep track of how much you earn, how much you spend, and how much you can save. Will give you a much better control of your financial future. So according to Bankrate, 34% of Americans live paycheck to paycheck. So if you find yourself in this situation where you don't really have, an extra $50 or $100 from this paycheck to the next, you're not alone. Again, it doesn't make you feel any better, but just know that, there are a lot of people struggling out there too and trying to figure out how to get out of it too. A lot of times once you pay off some debt, it'll get you out of that paycheck to paycheck cycle. And a new statistic, back in the day, back before COVID, if you're making $100,000 a year, you're pretty much, comfortable. But after COVID, approximately 20 to 30% of Americans making over $100,000 a year, still live paycheck to paycheck. A lot of times, things have gone up, so much. Like things are so much more expensive now. Just living expenses, just to live in certain cities, $100,000 is not enough for a single person anymore. But let's say here you're in Rochester, $100,000 is not enough to, raise a couple kids on your own anymore either. You're basically living paycheck to paycheck. So just be mindful that even though you're making $100,000 a year, that doesn't mean that you should allow your lifestyle to creep up along with your income as well. Just you don't want to get the new vehicle and that the new big house just because you're making $100,000 a year. It's just not enough anymore. Okay. Tracking your expenses and give you the freedom, financial stability. This way you know exactly how much you're spending in each category in your life. The category being, is it your dining out money? Is it your entertainment money? Is it your personal care, category? Your guilt-free spending. It's really important that you guys make up your own category to see what's important to you, right? What's important to me is to have some, fun money for my son and I to go on vacation or to go to different outings together. That's what's part of my category. You determine what's important to you, and you set a budget for that according to what's available in your budget. You'll know exactly how much is left over for different savings categories. You'll know how much is directed towards other bills as well, whether that bill comes monthly, weekly, or yearly. So budgeting, having a budget, it tracks your income versus your expenses. You can find the surplus or the extra cash that you can redirect towards debt repayment too. It's really important that even though you're going to be on your debt repayment journey, that you also start an emergency savings funds if you don't already have that. The emergency savings funds is strictly for emergencies, stuff like you need new tires, you need to get something fixed right away, like an emergency, not that the sale ends tonight kind of emergency. So that's a different kind. Knowing that you have dedicated funds available for emergency reduces your stress a lot. It lets you focus on your mental energy on staying consistent with your budget. So it's always good to start, like what is a good amount to start to have in your emergency funds, right? So you can always just start out with $1,000 or $1,500. It used to be $1,000 would take us a long way a couple years ago, but now I tell people to have at least $1,500, right? So in case something happens, things are just more expensive. And then once you have that $1,500 in your emergency savings, go ahead and start directing money towards debt repayment too. And again, let's take a look at the U.S. average household debt by type based on the latest reports and data from the Federal Reserves. Typical mortgage is between $234,000 and $252,000. This is across the U.S., not just Olmsted County or Minnesota. Auto loan, the typical balance on an auto loan is between $24,000 and $37,000. That's the average amount for student loans. Credit card debt, so the high interest debt, which can be used repeatedly, but if you have a high interest on your credit card, it's very difficult for you to get out of debt if you continuously have to pay on such a high, interest rate on your credit card. Home equity line of credit and personal loans, so those are the average balances on that. So when it comes to debt management, how do we start paying it first, right? So all of that talk just leads you up to this debt management. What is the steps? What are some of the steps that we have to take? Organize your debt. Figure out how much you owe. You can go to Credit Karma if you have that, or you can go to annualcreditreport.com. Take a look at all 3 of your credit bureaus and just write down, just go old school. Pen and paper, write down who you owe, how much you owe, and where your debt is at. So if you owe Capital One, but you haven't paid in a few months and it's sent to a collection agency, you can start out calling Capital One just to make sure that collection agency on your credit report is accurate, and they'll send you the correct information. And plan on paying which one to pay off first. Do you want to pay off the smallest balance off first, or do you want to pay something with the highest interest rate first? So determine what is the priority here. And most importantly, do not accrue new debt. And it's really important that you budget. Put an amount in your budget and tell you exactly how much to put towards these extra debt that you want to pay off. Things to consider when using, if you choose to get a loan to pay off all your high interest credit card debt, just remember that if your loan, make sure the interest rate on your loan is a lot lower than the interest rate on your credit card too, because it may be enticing to see an 8% loan, but if you are currently, paying 0% on a credit card, let's not get the loan to pay off that credit card just to lump it all together. And the length of time you're going to save, is it going to take you 2 years to pay off that credit card versus 5 years on the, on the loan to pay off all your credit card debt? Or looking to refinance your home and vehicle too. That's another option. That's another opportunity for you to find some extra cash, find some extra funds somewhere to pay off your credit card debt. And finally, if you can take a look at other credit cards and do balance transfers, right? But we want you to be very careful about it, because remember, when you apply for a credit card, it gives you a hard inquiry on your credit report, on your credit hit. So it lowers your interest, it lowers your credit score by just a few points, just for a little while. But if you don't think that your credit score is good enough to get another credit card with a large available balance, let's just not apply for it. Let's just work on how to actually pay off your, a few of the credit card first, and then we can look into applying for a credit card with the available balance to transfer, available credit to transfer the balance onto. So in this scenario, for example, Sarah, or back to Sarah, she owes null-net federal loans, student loans. The current balance here is $20,000, and the average interest rate is 5%. So the due date is the 10th of each month, and the late payment is on the 15th of each month with a late fee. So what she has left over out of that, understanding your interest rate is the next thing that I really want people to understand. So if you're paying 29% on a Capital One account with a $10,000 balance, or if you have a 5% on $2,000 balance with American Express, which one do you pay first? So it's really important that you pay attention to the interest rate that you're being charged and how much you're being charged each month. So in this situation, out of $200 that Sarah's paying, $83.34 of that is going towards interest, and $116.66 is going towards principal. So yeah, you are throwing $200 a month, or she's throwing $200 a month towards her debt, but she's not seeing $200 go down, right? That's because the interest rate is quite high. So that's why a portion of it is going towards the interest rate. I think the 5% is a little off, so I'll have to fix that, Christian. Sorry about that. The debt repayment strategy, so you have the debt avalanche repayment, where it focuses on paying the highest interest rate first. And the benefits is to save the most money on interest over time. So it's going to pay your debt off the fastest. The next one I really like for a lot of people is the debt snowball. So it pays your smallest balance first. So you organize your debt according to the balance and not look at the interest rate. So it's just the smallest balance first, and it builds motivation. It gives you little quick wins as you pay down your debt. So that's what I like to start people on too. So if you find yourself not as disciplined financially, I think the debt snowball would be a good idea for you to start. I'll give you an example here in just a little bit. And another option is a debt snowflake. So unexpected, little small windfalls, cash back. For example, it's tax season right now. So if you're getting, a large amount or even a small amount back, go ahead and start throwing that into your debt to pay it off. So if you're getting, random bonuses throughout the year from work, or grandparents or family and friends that are giving you extra cash throughout the year, for your birthday or what have you, put that towards your debt too. So that's considered the snowflake. Debt snowflake allows you to pay down debt slightly faster with small amounts of money. Another option to pay off your debt, if you don't want to just pay it off, by debt snowball, debt avalanche, you can get a debt consolidation loan. So it's really important that you make sure that you know exactly how much debt that you want to pay off, what kind of interest rate you're going to be getting with that new loan versus the current interest rate that you're paying on your current debt. You can also refinance your auto loan, your student loans, and your mortgage as well. You can do a balance transfer on a new credit card, or you can also get a home equity loan, a home equity line of credit. So if you have any questions on any of these, any of our member services representative or loan officers here will be able to help you out too. And another option, if you don't want to get those loans, you can talk to a consumer credit counselor, just like myself and a couple others here. You can talk with a debt settlement company. Just be very careful, because there's a lot of scams out there when it comes to debt settlement companies. But if you talk to a consumer credit counselor, that's a nonprofit. So, here I work for the credit union, but outside of here, like Lutheran Social Services, they're a nonprofit, so they can help you out too. I don't know how much they charge per visit or per session. That's something for you to talk about. But if you're a member here with the credit union, you can talk to us for free every single time. And the last resort would be bankruptcy. Is this something you really have to weigh the risk versus the risk versus the losing my words here, Christian, I'm sorry. The risk and the outcome of it, what are you trying to get out of it? Are you just trying to get rid of the debt the next few years? But also know that it's going to stay on your credit report for the next 10 years. And how will that affect you getting your mortgage? How will that affect you getting new credit cards to build up your credit score? What other places are you trying to move into, like a new apartment? Do they look at your bankruptcy? Will that affect you move into a new place and, getting a new residence and stuff? So recover from bad credit. So consider a secure credit card to rebuild your credit. Unfortunately, the fastest way to rebuild credit is to get another credit card. But before you do that, after you pay off your credit card debt, and before you apply for another loan or another credit card, I kind of want you to meet with, a counselor, whether it's a financial wellness counselor or whether it's a personal counselor, to try to determine what were some of the reasons that got you in debt in the first place? What is your relationship with money like before versus now? Is it something that you need to talk through? Were you using it as a coping mechanism during stress, during anxiety? Do you need a different way to cope besides spending money? So before you start, putting money on your credit card again, before you start spending money again on the credit card or getting a new loan, just be sure that you really address the core as to how you got there in the first place. Recognize and address any bad financial habits, and also be patient. Credit takes a lot of time to improve, really fast to mess it up, really long and hard to improve it. So give it some time. Okay, so if you plan on buying a house within the next 6 months or so, but you just filed bankruptcy earlier this year, that might not be a good time for you. So you might want to wait a few years. Okay, but it's always good to talk to a mortgage lender just to see what is your best option. Should you wait 2 years? Should you wait 5 years? Or what is the best option for you? And also, ways to make extra money. So when you're trying to pay off debt, for a lot of people, they find that they're living paycheck to paycheck already, and they can't find any extra money to put towards debt. So the best way to do that is try to make some extra money on the side if your time and mental health allows it. So we are in a gig economy, as a lot of people are aware. You can do ride sharing, you can do delivery, freelance stuff online. You can rent out, some of your assets. You can rent out a room in your house, or sublet your apartment. You can rent out your vehicle. Selling and reselling or flipping unused items. There's a lot of people that do that too. Or you can just pick up a traditional part-time job, whether it's online or, a brick and mortar place that you go to. So you have the ability to invest some time into a part-time job and use all of that money towards your debt and not, buy new things. So that'd be a good way for you to make extra debt or extra payment on your debt. So we'll just go ahead and do a little quick demonstration here. And so this, you have access to this online. If you don't, then please email us so we can send it out to you. So this is the debt snowball that I really like people to get into. So for example, you see how all of this is listed? So this is a Discover card, Capital One, American Express, Capital One again. Again, you can just, change this to your own credit cards that you currently have, the current balance, because we want to list it based off the balance because it's a debt snowball. So you want to pay the smallest one off first. We're not really worried about the interest rate at this time. So whatever it is, just leave it alone. That's for the debt avalanche. So here I like people to, let's say you're getting, a one-time startup, like an extra payment on your first credit card. What's really important to understand is during the debt snowball repayments and all your other debt repayment, you want to focus on one card at a time or one debt at a time. So just make monthly minimum payments for credit card 2, 3, and 4, and 5, but then really focus on your first one, okay? So now that it's tax season, you might be getting something back, hopefully. Let's say you want to put an extra like $1,000 in towards your debt, so you just put that in there. So what's good about this is it changes the numbers down here, right? So you don't even have to do any thinking. You can just change the figure up here, and then it'll change this for you. So this is the minimum payment on this debt right now, $2,200. Minimum payment is $57, and the interest rate is $27. We got a nice, tax return back. We're gonna put an extra $1,000 towards that. So the first payment, so it's gonna be that $1,000 plus the $57 minimum payment. Now remember, all these other ones, we're paying just the minimum payment on them, okay? But then we're gonna pay an extra $200 each month because we picked up an extra part-time job. So we're gonna pay an extra $200 each month towards his debt. So this very, very first payment, it's actually gonna be $1,257 because remember it said extra $1,000 plus an extra $200 on top of the minimum payment. So that first one brings it down from $2,222 minus that first payment brings it down to $965. As you can see, all these other debt, we're gonna keep with the minimum payments, okay? So it's really important that you do that. Don't pay a penny over. And then the second payment is gonna be month number 2 here. So month number 1, we dropped it down to $965. So we're still gonna pay the minimum payment, but remember, we're paying an extra $200 each month. So each month we're actually paying $257. So month number 2, we're paying $257. That drops it down to $723. Month number 3, so on and so on. But as you can see, when we get to month number 5, because we're paying $257, but the remaining balance is only $225.40. So we used up, out of $257, we used up $225.40 to pay off the first debt. But then we move on over to the second Capital One, the second debt. We're just gonna include the remaining balance from that first one plus the $125 minimum payment that we're paying before. And now it brings this balance down to $3,712.84. And then of course, we're gonna roll over the $257 that you're paying from here before. We're gonna roll that into the $125 minimum payment for the second debt. So now the new monthly payment for the second debt rolls into, comes out to $382. So that's gonna be until you pay it off. So as you can see here, the remaining balance is $366. And what's left over here, we're just gonna remember, roll it onto, that's why it's a debt snowball. Just snowball from one payment to the next one, it gets bigger and bigger. So the bigger the payment, the more debt you pay off. So this is a debt snowball. Again, you don't really have to do too much on this one, just play around with it. Let's say, what if you're able to only put $500 initially? Or what if you can afford to do anything extra to start out? So that's fine. What if you're able to, your part-time job is bringing you $239 extra that you can put towards a debt? You can change that and you can see all these figures change itself. So all you're responsible for when you work on this Excel spreadsheet is just change of course, the name if you want to, the balance, the minimum payment, and the interest rate on all of your debt, okay? Remember, the debt snowball starts from the smallest debt first and lists it all the way to the biggest one. So now we're looking into the debt avalanche, right? So we're just looking at the interest rate first. We don't care about the balance right now. We're just gonna look at the interest rate. So it goes from 30% to 27% to 17%. Again, I really like the debt avalanche for people that are kind of a little bit more on the discipline side, that knows that it takes longer to pay off the first one, right? Versus the debt snowball, it's a lot faster to pay off the first one, and then it's just snowballs. So you see a little quick wins, so it helps you mentally. But for the debt avalanche, it takes a little bit longer to pay off the first one. So this one is going to take you 14 months to pay off the first debt. So make sure that you're really disciplined for the next 14 months. Put as much extra money into this as possible. So, and with the debt avalanche, it saves you a lot of money with the interest that you're paying on these credit cards, because once you pay off the highest interest rate first, you're going to roll everything onto over the second one with the next highest interest rate. So the faster you pay the debt off, the more money you save in interest later on. So that's why debt avalanche saves you more money on the interest rate. So just again, play around with this. What if you can only put an extra $100 down as initial startup, but you can pay $500 each month extra on top of the minimum payment of $125 here? As you can see, that really brings it down to, instead of paying this off in 14 months, you're now paying this off in 7 months. And then it just roll that money onto the next one, onto the next payment. Again, keep paying the minimum payment and all these other debt while you're, focused on the first one, okay? And of course, the most important thing is do not accrue new debt, do not get a new credit card unless you want to, just get a new credit card to do a balance transfer. That's a whole different, quest altogether. But currently, the debt avalanche and the debt snowball are my two favorite ones that I like people to look into. But part of this Excel spreadsheet, I like to have people just list off, some of their debt, right? So this is pretty much the bread and butter of what I usually send people, have them fill out. This doesn't belong to anyone. If you're seeing this online, these are just some examples of how much things cost in Olmsted County in 2025. You can always change your payroll calendar. This is the MEFCU, Mayo Employee Federal Credit Union payday calendar, and Mayo's payday calendar. You can put that here. And then I want you to list off your income, right? So just start off with the basics. How much do you get from Mayo? How much is your spouse or your significant other? Or how much you're getting from your second job? Or if you're got one job and you're one person, how much are you getting? But go ahead and include it here. What is the total for those income? Is it $6,400? I'm just gonna make this just a little bit bigger here. I don't know if it's hard to see online or not, Christian, but, oh, I got too small. Okay, and then we want you to list off your fixed expenses. So your fixed expenses are things that are due pretty much the same amount and on the same date each month. So those are fixed, right? Things are like your mortgage and your rent, that's pretty much due the same day, same amount. Electricity, Minnesota Energy, car insurance, things that you pay on a monthly basis, right? And I want you to kind of list your monthly total here. I like to have people organize it according to your due dates, right? So instead of just having random, due dates or on your paydays, just go ahead and list it according to your due dates from the first to the end of the month. And then we're going to list the variable expenses. This is the category that really makes or break your budget. It's called variable because it does vary from month to month. It varies from season to season. During the summertime, if you have kids, your grocery bill might be a little bit more versus when they're in school, when they're getting school lunch or what have you. So groceries, even though it varies, we still want to put a cap on it, right? So we want to say, as a family of 4, we don't want to go over $800 a month in groceries. That means that it's $400 every 2 weeks if you want to just break it down every 2 weeks. And then household items, things are like paper towels and shampoos, cleaning supplies, things like that, household items. So we don't want to go over $150 per month. And in order for you to really see if these numbers are realistic for you, you might want to start auditing your accounts, right? You want to audit your credit cards, you want to audit your debit cards and see how much you were spending on groceries the last 2 or 3 months and just take the average of that. So if you're a family of 2 or a family of 3 and you're spending $200,000 or $2,000 a month on groceries, and you want to drop it down to $800, that might not be realistic. You might want to go ahead and just drop it down by $200-300 each month until you get to your ultimate goal. And our goal here is to try not to go over that because we want to have extra money to go towards your financial goals. So like savings and sinking funds. So again, different categories, variable expenses, whatever categories is good for you and your family. So just go ahead and put it down there. So these are, again, monthly expenses, right? But we know that there's some quarterly expenses, like the trash. Sometimes they only charge you per quarter. Certain streaming services charge you per quarter and stuff, or biannual. So every 6 months or so, if you want to pay your car insurance every 6 months, or you pay for some other subscription every 6 months. And yearly expenses, things like your taxes, your property taxes, if you don't already have it in escrow, or if you're paying for like your Microsoft, subscription and stuff. So you want to list that on here too, what the expense is, the amount, and when the due date is. So it's really important that you want to include that as part of your sinking funds too, because what if your tabs are $600 a month and that's too much for you to pay in one section, to pay in one payment? So go ahead and take $600, divide it by 12 months and see how much you have to save per month and put that towards your sinking fund. So with MEFCU here, you can have as many savings accounts as you want without any extra charges. So you can name each one of your savings account, your Christmas fund, your car maintenance, house maintenance, miscellaneous, or school funds, whatever it is. So that'll be your savings category, okay? I like to do what's called a zero-based budget, where out of $6,400, you're telling every single dollar what to do. So every single dollar is a job. So that way it's just not sitting out there hanging out and you wasting money on it. So really it shows zero left over, but it's not really depriving you of anything because you have different categories that you have a budget for already, right? You have the hobbies category, the personal care, how often you get your nails done, your hair, your beard trimming, whatever it is. Entertainment going out, you have a budget for that too. So really you're not missing out on anything. It's just a form of freedom for you to know how much you have in that guilt-free spending. If you just want to simply just put in guilt-free spending, you're more than welcome to do that too. But then also because we're trying to figure out how to pay off debt sooner, just put a category, just an extra payment, Macy's payment, just do an extra like $200. And then how does that look like in your budget? Do you have it available in your budget to pay that? Because if we put $200 extra towards the debt repayment, now it's putting us in the negative $200. So where can we take $200 out of this savings category or out of this variable category? Then you start readjusting things, right? So, maybe we don't need to spend $150 a month on household items. Maybe we just want to drop it down to $50 per month while we're trying to pay off our debt. Or maybe I don't really need to get my nails done every 6 months, every 6 weeks, or every month. Let's just go and drop it down to, let's just say $50. So as you can see, now we're only negative $50. Where can we find this extra $50 from? How about going out? Maybe we just need to stay in a little bit more and just you spend $50 a month. So now you're back down to equal zero. A zero-based budget, because you're trying to figure out, where to take where to find that extra money to put towards your debt repayments, right? And then I like to scroll down here. I like to have people kind of write down your accounts. Where are all your accounts at? How much is the balance? What is the date according to that balance? Just so you know. And then some of, financial goals. After you pay off debt, do you want to take a family vacation to Europe? How much is it going to cost you? And then here, I kind of want you to list where all of your debt is at, right? You want to list your creditors. It's really important to list off your interest rate, your current balance. What is the credit limit? Because we want to know if you're getting close to hitting. What is your credit utilization is what that is for. Do you need to lower certain credit cards to get under 30% credit utilization so your credit score can bump up? Or are you just wanting to pay things off according to the balance? What is the minimum payment? And it all adds up here, right? So you want to list off everything. It includes your mortgage if you, if you have that. It includes your student loans if you have that. Anything that you owe money to, just put it there. And you can always make extra lines for yourself too. In this category, or in this section here, I like to have people if you just scroll this over, it's always going to move, but then your main page is always going to stay here available for you. When I work with people, there's a lot of people that I work with that I meet on every 2-week basis. Every payday, or a day before or a day after their payday, you kind of write down how much you got paid. So did you get paid from, let's say, the city, $1,700, and as you see, it changes $1,700. But then you kind of write down, what bills are due. So I'm just gonna put some figure down here. But as you can see, when you try to budget that per 2 weeks, you can see how much is left over, the amount that's left over, so that way you can spread it between, how much you can put towards groceries, household items, stuff for that payday, for that paycheck. And then you can see how much you have left over to put towards your debt as well. So it's just a way for you to really keep track of where your money is going to, like really plan out where your paycheck is going to, because if you don't have that plan, a lot of people just kind of, I don't know how much I have left over, but I'm just going to go ahead and buy this, purse that's on sale because it's going to be gone by the end of the day or what have you. But if you already have a budget, if you're keeping track of it, where every dollar is going, the job of every dollar, then you have a better control over where your budget goes to. So again, this is all free for everyone. Just, download it, save it on our website. And then if you're really want to get into bird's eye view and see what you've been paying, year to date and stuff, you can play with this screen too. An account inventory, I like to have people put in one sheet where all of your financial stuff is at. Who do you currently bank with? What kind of investments do you have? What kind of assets? Just list them off in case something happens, because a lot of times when I meet with couples, one of the two know where everything is at, the other one is just kind of there just for moral support, So it's really important that you put things in one sheet just in case the other person needs to get access to it, or your family members need to get access to it in case something happens to you. So it's really important that you have that. But otherwise, for the debt avalanche and for the debt snowball, I really recommend people just really starting out with the debt snowball first, because after you feel that rush of paying off your first credit card, you're going to keep wanting to continue on and pay the rest of it off too, and continue on with the process. Because remember, in order for you to reach your goal, the goals are really, really good to have, but it's a process, it's a journey, and it's the procedure that you're doing in the process of reaching those goals that will really keep you on track to paying your debt off. Again, if you have any questions with this, feel free to ask me or other financial wellness counselors, and we can walk you through this. Or if you want to meet with us, to set up your own personal, debt repayment journey, we're more than welcome to, help you with that too. So let me just get on here. Excuse me. Oops. And okay, so that concludes my presentation on debt repayment today, or getting yourself out of debt. This is my contact information. Again, it's going to be on the financial education tab and on our website too. So if you have any questions, just reach out to us and we'll be more than happy to help you figure out the download. If it's not on there already, we can just email it to you, okay? Do you have any questions here in person or online, Christian?